So, we've been talking about like buying or investing in real estate, and you know, there's a bunch of different scenarios, and the standard scenario for buying commercial real estate is something like, you find a property you like, the seller agrees to sell, and a financial institution provides the financing. However, there's going to be some instances where, for a bunch of different reasons, whatever they may be, the traditional process just isn't possible. It's not feasible. And in that instance, there's other options, and one of them is going to be owner financed real estate, right? So, what is an owner financed real estate deal? It's basically just a transaction in which the seller provides financing to the buyer rather than a financial institution. So let's kind of go over this, but we need to start with the basics. Let's talk about the basics, right? So essentially, owner financing, um, also referred to as seller financing. The terms are interchangeable. Means that the owner of the property is willing to finance the purchase for the buyer. Now, in these instances, the seller also acts as the lender and sets up the terms of the loan. Typically, the agreement will come in the form of a promissory note, which will detail the loan amount, the interest rate, and your repayment period. Now, there's going to be a bunch of buyers that turn to seller finance deals because they might struggle to get a traditional mortgage or something like that, and that's not always the case. There are a variety of opportunities where owner financing makes sense for both parties. A misconception is that owner finance transactions are only for situations in which there is no other choice. And that you know the buyer can't secure third party financing, or the property has uh, you know attributes or challenges that make bank financing difficult. The truth is that seller financing can make sense in a bunch of different situations, including institutional transactions. Okay, well, then what would be some of the advantages and disadvantages? Okay, well, as with any commercial real estate deal or real estate deal in general, there are attributes and challenges for both parties involved. One of the most often cited benefits of seller finance deals is that they move quickly. Since you're not getting a bank involved, it's reasonable to save weeks, if not months, on reports, searching for lenders, dealing with underwriters, and completing bank required documents before closing. It can also often mean that buyers save on some of those traditional bank related costs and fees up front. While a swift transaction can be an advantage, it's also important not to let, your due diligence slip through the cracks in favor of, you know, speed, especially when it comes to environmental or like appraisal assessments. Now, buyers complain about the time and money spent, getting environmental reports, tax return documents, so that they can prove income from the asset, and having to get an appraisal completed. But these steps are there to protect the buyer as well as the lender. Seller finance transactions can offer purchasers the opportunity to complete transactions that they would have difficulty financing through traditional means. For investors with less than stellar credit, for those purchasers seeking to acquire more out there or esoteric assets, mobile home communities, marinas, the list goes on and on. Or even just for investors interested in certain value add scenarios. This approach can make otherwise challenging transactions feasible. A common benefit for sellers is that owner finance deals can provide ongoing income. If the exiting seller has no debt on the property, a promissory note structured for payment terms over a set period represents a predictable stream of passive income. However, if the buyer misses payments or cannot keep up with the loan, then the seller may have to reclaim the property. If that does happen, the loan income goes away, and there are often costs associated with the foreclosure. It can also be a concern if the property needs extensive updates or repairs to get it ready to go back on the market. You know, any use in which, the buyer is permanently altering the nature of the asset is not a good candidate for seller financing for that reason. Additional tax advantages, for the seller, you know, is another potential benefit. However, it's important to review your tax situation with a professional to determine the specifics, especially if you're new to these types of deals. Well, then let's talk about some of the contract terms. What would be in some of these contracts? Because seller financing, I mean, seller financing is often just like a whirlwind of a transaction, right? Because it is so fast. There is no long underwriting or document review process like there would be with a bank mortgage. So a lawyer should be retained to make sure nothing slips through the cracks, especially like I said, the transaction is gonna move real quick. Now, it's not uncommon for an owner finance deal to have a structure that's different from a conventional mortgage. So in many cases, the seller will, amortize the payment over a longer term, typically anywhere from 15 to 30 years. However, they will often ask for a balloon payment much sooner, often within 5 to 7 years. In order to fulfill the requirements of the balloon payment, it may be necessary for the purchaser to refinance the property. Accordingly, it's essential for, buyers to pay close attention to these terms. You know, in entering into seller financing, buyers got to be confident that they will be able to refinance a property within that period of time, prescribed by the note. Obtaining beneficial contract terms is just very crucial for sellers. An example would be retaining the option to sell the loan to a third party. That option can provide the seller with a lump sum or regular monthly income before the maturity date on the deal. While it might seem relatively straightforward on the surface, there are many factors to take into account before exploring any owner finance real estate transaction. You know, what is important is understanding that, and we said this before, your investment is going to succeed or fail due to the income and appreciation of the project, but make sure that you're not, don't make a bad investment because it has good financing terms, right? You don't want to look at something and say, well, the financing terms are really in my favor, but the property itself might not be good at all. So you really got to be careful. Really hope you guys got some good information out of this, as it's going to help you decide whether you want to get owner financed, or seller financing, however you want to word it. It help you buy commercial real estate, residential real estate, investment real estate, or even if you're looking at buying a business, this might be an option for you. But I hope you guys enjoyed the video. If you did, I'd appreciate you hitting that like button. If you're not subscribed to the channel, just go ahead and hit that button. But until I see you guys in the next video, y'all be safe.